Behavioral Finance Notes, Episode 5, Measuring Investor Sentiment, From Intuition to Evidence. Welcome back to Behavioral Finance Notes. In the previous episode, we discussed limits to arbitrage and why mispricing, even if recognized, may not be easily corrected. But this leads to a deeper question. If mispricing is driven by investor sentiment, how can we actually observe sentiment in the data? Sentiment is not directly observable. We cannot measure optimism or pessimism in a clean, direct way. So if behavioral finance aims to explain asset prices empirically, it must first solve a fundamental problem. How do we turn an unobservable psychological force into measurable variables? Investor sentiment is often described as beliefs that are not fully justified by fundamentals, but this immediately creates a difficulty. To identify sentiment, we will need to know what the correct fundamental value is. In practice, that is not observable either. So instead of measuring sentiment directly, researchers look for proxies, observable variables that turn to move with speculative demand. But any single proxy is imperfect. This is why researchers such as Michael Baker and Jeffrey Wagner proposed combining multiple indicators into a composite sentiment index. The key idea is not to observe sentiment itself, but to observe the behaviors that sentiment tend to generate. The first proxy is the closed-end fund discount. Closed-end holds a portfolio of assets, but their shares trade at market prices that often differ from the value of the underlying holdings. When sentiment is low, investors turn to sell these funds, and the discount widens. When sentiment is high, demand increases, and the discount narrows. Because these funds are often held by retail investors, their pricing can reflect shifts in investor mood more directly. In this sense, the discount acts as a window into investor sentiment. The second proxy is the IPO volume. When investors are optimistic, they are more willing to invest in new and uncertain companies. At the same time, firms are more willing to issue equity when valuations are high. This creates waves of IPO activity during periods of a strong sentiment. Historically, major IPO booms tend to coincide with speculative market environments. So high IPO volume can signal elevated investor optimism and demand for risky assets. Closely related is IPO first-day returns. When newly listed stocks experience large price increases on the first day of trading, this often reflects very strong investor demand. High average IPO returns suggest that investors are eager to buy at increasingly higher prices. From a behavioral perspective, this can indicate a speculative enthusiasm rather than purely fundamental valuation. Another proxy is the equity share in new issues. Firms can raise capital through debt or equity. When sentiment is high and stock prices are evaluated, firms turn to issue more equity. This increases the shares of equity in total financing activity. In these things, firms respond to investor sentiment, and their financing choices become an indirect measure of market condition. The final proxy is the dividend premium. This measure compares the relative valuation of dividend-paying firms and non-dividend paying firms. When investors prefer stability and income, dividend-paying firms tend to trade at a higher relative valuation. But when sentiment is high, investors may prefer growth-oriented firms that do not pay up dividends. As a result, the relative valuation of dividend-paying firms declines. This shift reflects changing investor preferences between safety and speculation. Each of these measures captures a different aspect of investor behavior. Some reflects retail demand, some reflects corporate financing decisions. Some reflects investor preferences across types of firms. Individually, they are noisy, but together they may reveal a common underlying factor. This is why researchers combine them into a sentiment index, often using statistical methods to extract the shared variation. This is where the connection to limits to arbitrage becomes important. Sentiment does not affect all assets equally. It tends to have a stronger impact on stocks that are difficult to value, difficult to arbitrage, and sensitive to speculative demand. This includes small firms, young firms, and unprofitable firms, because arbitrage is limited in these segments. Sentiment-driven mispricing can persist. So measuring sentiment is not just about psychology. It is about understanding where and when market frictions are now believed to influence prices. Investor sentiment may be unobservable, but it leaves systematic traces in financial markets. By carefully studying these traces, behavioral finance transformed an abstract psychological concept into something that can be tested empirically. Understanding how sentiment is measured is therefore a crucial step in moving from intuition to evidence. Thank you for watching Behavioral Finance Notes.